So we are, hopefully you all know, we're here today to talk about the domestic reverse charge and the changes that come into force within the construction industry and the VAT sector. So this is going to start from the 1st of March 2021, so next week. So we haven't got too long. As if you were here in our little chat just before the start, you will have heard that this has already been delayed. So HMRC were due to introduce this in October 2019, so a long time ago now, and it was canned about a week before. So which is why we're slightly late getting this information to you, and also why I think the accounting systems are also a bit late, which Bella will talk to you about in a minute. So yeah, this relates to any supplies from the 1st of March 2021 onwards, and that's relating to the tax point. So which, I mean, there's some complex rules around the tax point, but generally it's the earlier of the invoice date or the payment date. So if you either invoice after the 1st of March 2021 or you're paid after the 1st of March 2021, whichever is the earlier, then this will apply to that transaction. Again, as we briefly alluded to, the intention is to ensure the VAT is correctly accounted for by subcontractors. Currently, HMRC have identified that there's some fraud within the system. So subcontractors have been charging their contractors for the VAT and then not reporting or paying it back to HMRC. So they've obviously identified there's a significant hole there, and this is their way of trying to correct that, I guess, rather than having to go after the individual subcontractors specifically. So the domestic reverse charge is going to move the responsibility to the contractor away from the subcontractor. It's going to mean that the contractor will be reporting and paying that VAT on behalf of the subcontractor back to HMRC. So we'll go into all of the detail, but that's briefly what it is and what it's for and why it's being introduced. Just a quick note, the domestic part of the title, the domestic reverse charge, that just relates to the fact it's the UK, domestic to the UK. There's already an EU reverse charge VAT system in place, which some of you may know about, but it's a completely separate system, and the domestic just means that it's UK based. I'm assuming they've kept the name fairly broad, although this only is affecting the construction industry currently. I'm guessing it's something they could quite easily move into other sectors with, which is why they kept the name fairly broad. So who does this apply to? So if you're a business within the construction industry, subcontractor or a contractor, and you're VAT registered, then this is likely to apply to you. So if you're VAT registered and your customer or supplier is VAT registered, and you're within the construction industry and the supply is a construction supply, then this is likely to apply to you. It's only going to apply to services that are standard rated or reduced rated, not zero rated. But it's yeah, essentially if those tick boxes are checked that you're VAT registered, it's a CIS supply, and your supplier or customer is VAT registered, whichever way that invoice is going, then this is likely to affect you. It doesn't affect you if you're an end user, so VAT will be charged to you as normal if you're an end user. We will go into end user status just a bit later on. So as always, VAT rules are never that straightforward, so there are some exceptions. So if it's non-construction operations, so it doesn't fall within the CIS rules, then it's not going to apply. The DRC won't apply. Just very briefly, some aspects that you might supply but don't necessarily fall within the CIS supply of normal labour and building materials would be carpets, installation, hire of equipment, and landscaping. In terms of hire equipment, scaffolding is slightly more complicated and can sometimes fall within CIS, but I would refer you back to the CIS rules to just ensure that your supplies are within the CIS reporting or not within the CIS reporting. So as alluded to, zero rate supplies, it doesn't affect because there's nothing really to report or any VAT to pay here or there. So obviously new build supplies aren't going to fall within the DRC. And then there's the specific 5% disregard. So if the CIS element of the full supply is less than 5%, then the DRC does not need to be applied. In fact, it shouldn't be applied, so it is not optional. If it's less than 5% of your total invoice, say you had labour materials, which were both CIS supply, and then you had a number of other parts of the supply which don't fall within the CIS rules. If that element of the labour materials that does fall within the CIS is less than 5% of the total, then the 5% provision applies and the DRC won't apply. If it's more than the 5% the CIS supply, 6% say, then that DRC applies to that full invoice. So it's not just the CIS element of the invoice, it's that full invoice. So this is just a brief example of where we are now and where we'll be after the 1st of March. So currently the top line shows the subcontractor invoicing to the contractor, CIS labour and materials of £1,000, VAT charged on that of £200, and the subcontractor will report and pay that £200 to HMRC, although HMRC believe they're not doing that, and that's why they're bringing this in. The contractor will then invoice their end user or potentially the next contractor, in this situation £2,000 plus the VAT of £400, and then they will report their output VAT of the £400, the input VAT that they've claimed from the subcontractor, and then therefore pay that £200 to HMRC. So you can see overall HMRC are getting £200 from the contractor plus the £200 from the contractor, £400 in total. Following the DRC rule change on the 1st of March, the subcontractor on the same invoice will be charging, oh, sorry, that's wrong. The subcontractor will be charging £1,000 and not charging that £200. This slide's changed, sorry. I'll come back to this and do a screenshot of a workaround on this, but just briefly to explain it, the invoice will not show that £200 VAT, that will not be charged onto the contractor, and the subcontractor will not be paying that to HMRC. So the contractor position will be, again, that will be completely changed. I'll come back to that, sorry. So the impact on the contractor and the subcontractor, following the change, the contractor is now bearing the responsibility of paying the VAT to HMRC on behalf of their supplier. So it's no longer the subcontractor's responsibility to charge and pay that, it's now the contractor's. That's achieved by the contractor making an adjustment on their VAT return rather than paying the VAT to the supplier and then the supplier paying that on to HMRC. This would make more sense if my previous slide was correct. The contractor will also claim the input VAT on the supply as usual. So you're going to have as the contractor, you're going to have that £200 in the output VAT and that £200 in the input VAT. So your net effect is nil, but that's going to HMRC because the subcontractor isn't paying it to HMRC. So you can claim the input VAT to offset that output VAT. Now that brings the risk onto the contractor to ensure that that DRC has been applied correctly, and the input VAT reclaim could be rejected if it's not. So if you're unsure that the invoice that you've been provided is correct and the DRC should have been applied or shouldn't have been applied, then you need to reject that invoice if you believe it's wrong, because if your input VAT reclaim is rejected, then obviously you lose out quite considerably. You do charge the VAT, your output VAT, in the usual way at the applicable rates to the end user or onto your customer. So the subcontractor no longer accounts for the VAT on a DRC invoice. So it no longer charges the VAT and it no longer pays the VAT over to HMRC. This can lead to some issues around cash flow, which we'll talk about later, because you're no longer receiving that VAT. So you're no longer receiving that £200 in the example that you previously were. You'll only be receiving the net amount. The subcontractor is still responsible for correctly applying that DRC on the applicable CIS supplies. So if your supply does fall within the DRC rules, then you will need to make sure that your invoicing is correct. We'll go through an example invoice just a bit later. And that invoice will need to state that it's a DRC invoice and what the charge should be. So how is this going to affect cash flow? So for subcontractors, you're likely to experience a reduced cash flow. So if you're tight with your cash flow anyway, this is likely to make it worse. If your network currently is £1,000, less your CIS of £200, plus your VAT of £200, you'll be receiving £1,000. After the 1st of March, you'll no longer be receiving that VAT. So you're going to be £200 worse off. You're only receiving that £800. Obviously, you were only ever collecting that VAT on behalf of HMRC anyway, and you were just holding it to repay to HMRC. But in terms of your cash flow, it could well make a difference. In terms of contractor cash flow, you'll probably be better off. If you're tight, then you won't have to pay that VAT to your subcontractor. That will stay in your bank until it's paid to HMRC. So you'll have that money for a bit longer. So what can we do to improve the cash flow for if you're a subcontractor and you're a bit tight? This is a really important point. If you're on the flat rate scheme still, you need to leave it because you'll be paying VAT over that you're not collecting. The flat rate scheme, for anybody who very briefly doesn't know, is a simplified VAT regime where you're paying a percentage based upon your sector of your gross turnover. So you don't charge and collect VAT in the same way. You charge it on to your customers, but you don't then claim the input VAT. It was really popular for a while in certain areas because people found they could make money off of it. To be honest, if their percentage rate was say 12% and they were charging 20% of their customers that to claim, they were able to make money off of that. Now that's not been the case for a few years because there were some changes a few years back, but absolutely now you need to come off of the flat rate scheme because you will be losing money in this situation. So if you're eligible, you could apply for gross payment status within the CIS scheme. This means you won't have the CIS deducted from you at source, and therefore obviously that improves your cash flow. You hold on to that money until you need to pay HMRC in tax. There are certain criteria for gross payment status, and which we can go through if you want to have a chat about that later on. But briefly, I think you need to be turning over CIS turnover, so not all of your turnover, but actually applicable CIS turnover of £30,000 per partner or director, depending upon your business. So you may find it's worth doing from a cash flow perspective, regardless of the VAT changes, to be honest. So that's something to consider. If you fall below the VAT deregistration threshold of 82,000, you could consider deregistration. If you think you can stay under that for 12 months, then you can apply for deregistration and come completely out of the VAT regime and not have to worry about it. People have other reasons to be VAT registered rather than just being forced to because of turnover, but that's something to consider for sure. The other thing to consider is applying for monthly VAT returns rather than quarterly, so you can accelerate that recovery of the input VAT. So you're claiming that input VAT.
I don't think there's going to change here, but I'll listen.
Sacrificed much more readily, so you can have it back monthly. Obviously, that increases the admin burden, potentially costs if you use a bookkeeper, but something to consider. And obviously, do talk to us about that if you want to. So I said I'd talk to you about end user status. So the end user is the consumer of the service. So if there's not going to be any onward supply of that construction service, that's the end user. Now that's often quite obvious. If I was the end user, for instance, I was having an extension on my house or something, I'm just a domestic user, and it would be very obvious that I should be charged VAT as normal. And I'm the end user. It's not always quite so obvious in some situations. Potentially if you're working for a contractor who charges on some of the construction service, but maybe you're also working for your contractor on their own head office building or such like, then part of that supply is an end user supply. So the office that you're building for your contractor would have end user status, but potentially part of the rest of the supply wouldn't. Now the end user is responsible for ensuring that the DRC is not applied to services to them. So they can issue a statement to you as the contractor to ensure that they let you know that they have end user status. They do need to inform you of that. So if it's really obvious, like, you know, in the situation, as I just said, if it's me and you're extending my house, that's 2 extensions I've had today, so doing well at that. But then you wouldn't need to worry about it. But if you're not sure, then you can be issued an end user status. And HMRC have actually provided some wording for this, which is quite handy, which I've just put at the bottom of this slide, which obviously you'll have access to. So again, this comes directly from HMRC. This is quite handy little flowchart where you can see if it's likely to apply. So firstly, does it fall within the scope of CIS? Well, if it doesn't, don't worry about it. Normal VAT rules apply. You charge VAT as normal. You're good to go. Is the supply reduced rated or standard rated? Yes. Then so you carry on down. Is your customer VAT registered? Yes. Then are they registered for CIS? Yes. Have they provided confirmation that they're an end user? No. Then the domestic reverse charge applies. So the standard is that the DRC does apply unless any of these exceptions occur. So this is a handy little flowchart that should help you have a look at each supply and invoice and be able to work your way through it. So responsibilities of the subcontractor: you need to check that your customer is not an end user and has not provided a statement in this regard. If they have provided a statement, then you charge VAT as normal. You can also check that your customer's VAT registered. So if they've said they're VAT registered, you can check that. You don't need to, but it's probably a good idea if you're not 100% certain. You do not charge VAT on that invoice if it's a DRC invoice. So you don't want to charge VAT, and you will not be paying that to HMRC. And this isn't optional. So if you fall through that flowchart and it comes out as a DRC invoice, then you can't just choose not to comply. The invoice will need to detail that it's a DRC invoice and show the VAT that would have been due but isn't charged on. And I'll show you an example of an invoice a bit later. And from the contractor side of things, you need to be really careful to check invoices that you're receiving from your subcontractors to ensure that you're happy with the treatment. If you're not happy with the treatment, you need to reject that invoice, because as stated earlier, if you claim that input VAT incorrectly, then you're not going to get that back. So the key to all of this really is communication up and down that chain with your contractors and your subcontractors to ensure that you are happy that the supply does fall within the DRC rules and that everyone in that supply chain is happy with that. So it's mostly about communication, just to make sure everyone knows where they stand. As the contractor, you must now account for your supplier's output tax, as detailed on the invoice provided by the subcontractor. So this will fall into box 1 and box 4. Box 1 for your output VAT, box 4 for your input VAT, and you claim that input VAT as usual on your VAT return. So you will not be paying that VAT over to the supplier. You'll only be paying the net amount to the subcontractor, and therefore the VAT you pay directly on to HMRC. So what should you do now? As a subcontractor, you need to consider your cash flow implications. If you think you're tight with cash flow in any way, do run through that list I had just earlier and think about any actions you could take to help that. It's definitely worth doing if you're not quite sure where you stand. You need to be reviewing your contracts and talking to your contractors to discuss the DRC and its application, as just stated, you need to make sure that when you're supplying your contractor with an invoice that is subject to the DRC, the contractor needs to approve that invoice. So you need to make sure that you're happy with the treatment. You want to also ensure that you're confident with how your accounting package will manage the change. So Arabella is going to discuss the accounting packages Xero, Quickbooks, and to some degree Sage. Most people probably that are VAT registered are going to be using one of those these days. Obviously, if you have more specific bespoke systems, then we can talk to you about that, or you need to talk to your accounting supplier to have a look to see how that's going to work. So the contractors, again, you need to review your contracts with your subcontractors and discuss the DRC and its application to ensure that you're receiving correct invoices from your subcontractor with the DRC applied where applicable. Review any contracts with your customers and make sure you're happy with their end user status. So if it's unclear, then you want to make sure that you have a statement from your end user, if that's applicable, to tell you that they are your end user. And again, ensure you're confident with your accounting package and how you're going to apply the DRC and how that's accounted for on your VAT return. Unfortunately, the slide that was incorrect shows how it works on the VAT return. Once Arabella's doing her chat about things within the accounting packages, I'll just pull up the slide and correct the slide, and then we can talk through that as well. So, other considerations. A couple of things here, really not related, but I thought I should bring them up. So, cash counting. Many of you will probably be on cash counting, and unfortunately the DRC transactions cannot be accounted for under cash counting. However, you don't need to come out of cash counting entirely for this. So you don't need to go back onto standard accounting or invoice accounting. So if you have mixed transactions, which is very likely, you can carry on using cash accounting for the remaining transactions, but the DRC transactions will be accounted for on an invoice basis on your VAT returns. And the accounting packages have sorted this for you, so you don't need to worry too much about that. And self-billing. So some of you may be on self-billing and with your contractors, and there are some transitional rules just because of the dates involved here, just to determine when the supply falls, which dates the supply fall within. So these are the bullet points are just the parts that show where the dates fall. So if your supplies are entered into the accounting system, so your self-billing accounting system, and it's entered before the 1st of March and the payment date will be before the 31st of May, then the DRC doesn't need to apply, the normal VAT rules apply. If it's before the 1st of March and it's after the 31st of May, you do need to use the DRC. And if it's entered after the 1st of March, then you need to use the DRC regardless. So you've just got a few months of, just because there's always such a delay with self-billing, HMRC have allowed a few months for that to take effect. So this is an example DRC invoice from a subcontractor. So as you can see, the invoice is fairly standard. However, within the VAT column, it says reverse charge applies. So no VAT is actually charged. It's not added on to the invoice. It just says reverse charge applies. And the customer to account for HMRC for the reverse charge output tax on the VAT exclusive price of items marked reverse charge at the relevant rate as shown above. So this puts the contractor in the position of working out the 20% and the 5% and applying that correctly on their VAT return. So this is just an example of how the DRC invoice should look from a subcontractor. Okay. Well, thank you very much. I'll hand back to Nigel, who can hand you over to Arabella, and I'll sort out my slide and then come back to you afterwards.
Better unmute myself. Thanks, Dawn. That's fantastic. Appreciate there's a lot of detail there to take in. You will all get a copy of the slides with the correction after the end of the webinar, so you can look through them and digest them at your leisure. There's some interesting queries and questions that it prompts. One of the points that Dawn mentioned early on in the session, but I don't think she emphasised, is that the DRC applies to tax points from the 1st of March onwards. If you're doing long-term contract work and you've not invoiced your customer yet, you'd be well advised to issue a 28th of February invoice to them and get all the work you've done so far under the old system. Otherwise, you're going to have to apply the DRC possibly to several months worth of work if you were to invoice it next week, which doesn't seem to be a very smart thing to do. So try within your bookkeeping system to get a cut-off at the end of this month. And that'll at least make life a little bit easier, won't it, Dawn?
Yeah, definitely. I mean, if you don't invoice monthly at the moment, it's certainly a good idea to do that this month. Yeah, I mean, it's a good idea from a cash flow perspective anyway, to be trying to invoice as often as possible and not leaving it for months and months. But yeah, definitely in this situation, it's worth doing. Yeah,
so you might need to do an interim invoice if you're sort of partway through a contract. The other thing I was halfway writing down, and then you answered the question yourself, is the accounting software now is therefore going to have to be able to work out a VAT return that takes DRC transactions on an invoice basis and other transactions on a cash basis. But you're pretty happy they can do that, are you?
Yeah, I mean, certainly Xero and Quickbooks have said they can, and it would make sense that it's actually probably fairly easy for them to do that, because it's just going to be based upon the dates. So rather than from a cash accounting perspective, they'll use the payment date in this situation. If anything's marked with a DRC VAT transaction code, then it will just fall within an invoice date situation. So I think it's probably actually easier than it sounds from an accounting perspective if you're using software. If you're not using software, you're going to have to be careful of it though.
Yeah, another complication, isn't it?
Yeah.
Okay, well, shall I pass over then to Arabella, who is going to actually show you what this looks like in some of the software that we use. If you're not using software, this is also a little demonstration of how much easier your life could be with a little bit of computer power.
Great. Okay, thank you very much, Nigel and Dawn. Let me show you how it's going to look. We'll start with Xero first. So let me share my screen. So this is a demo company that we have set up in Xero, and the place where you will first make your starting point is in accounting and advanced. Let's try again. Here we go, right. So you would then go to tax rates. Oh, great, that's a little bit quicker. And can you see this bar here? It's saying add the domestic reverse charge tax rates. So you'll need to go in and to click on this, and then you want to confirm. They've preset these, but you just need to switch them on. So that's what I'm going to do here. Add domestic reverse charge tax rates. So those have updated the system, and now they are options here for you to choose when you're creating your invoice. So we can go in and create quickly a sales invoice in our demo company. So I'm going to use the imaginatively named ABC. Just ignore the names, but here we go. We've got the due date, 30 days, an invoice number. Oh, a reference, sorry, 1, 2, 3. So we're going to put in here labour, and we're going to choose £200. I think when you have your Xero, when you're set up already for CIS labour, but we'll choose sales. Then you come onto your tax rate. And you can see now that you have the choice of domestic reverse charge VAT on income. So this is the one that you would choose. And I'm going to approve that, and then I'll print a PDF copy, and you can see that this will look like the invoice that Dawn showed you earlier. So here is the invoice then that you would send to your supplier. You can see it's picked up the instruction for the domestic reverse charge. So your contractor will be happy to see that on the side of an invoice. It's explained that it's used the domestic reverse charge 20% on this central section here, but you can see it hasn't actually added on the VAT there. So that's what your invoices will look like. And because there's no VAT, then the VAT element won't show in your VAT return. I'm just going to close this. And go back here. And we can see what that looks like. Doesn't like accounting very much today. I might not be able to show you because it might want to think it wants to link into MTD. Here we go. So we've got an end date, 28th of February. I thought it might just take any. No, thank you. So here you can see that it automatically hasn't put it in as your £200 because there is no VAT. There's no VAT on that sales invoice, but it has put it here, the £200 for your value of sales. So that's where it would show in Xero in your VAT return. Now, if I take you over to QuickBooks, and at the moment, QuickBooks have said that from the 1st of March, it will have 2 new VAT codes, but I can, so they're not set up at the moment. We checked this morning, but I can show you where you would go to. So you would come to taxes and to VAT, and then you would go to edit VAT and choose edit rates. And then this little cog here is where you will go to and include inactive. And then this is where all the codes will come up. And by the 1st of March, they've said that the codes will be on here for our domestic reverse charge. Not this one, don't get muddled up with this one, which is the reverse charge services that is currently in place for EC services and EC goods. So there will be another one on here, which are your 2 5% and 20% reverse charge services. In Sage, there's nothing on there as Dawn said. They haven't updated their system with anything that I can show you right now. But there's going to be a click button in each of the suppliers where you can choose reverse charge VAT. But they've got comprehensive instructions on their website, so I won't repeat those here. So that's as much as I can show you of those at the moment. So I'll hand you back to Nigel.
If you'd like to stop sharing your screen, Dawn, have you got that?
Yeah, sure. Let me have a. So just quickly, this is the section of the Sage website which shows about the reverse charge VAT. and how you set it up within Sage. So if, again, maybe we can, when we send out the recording, maybe we can give you a link to this. I was thinking as well if we could give you a link to the flow chart that HMRC provide, because it's quite useful to have. So we'll provide you with that when we send everything out to you. Right, let me show you the corrected slide, which I think is probably more useful than any of the other slides available. So, right, so we talked through obviously the situation now at the top. You should all be aware of how the VAT works now. So afterwards, just to confirm, the subcontractor will be invoicing their labour, materials, CIS for £1,000. The DRC, which is not chargeable, so this will not be invoiced, this £200, and it will not be reported to HMRC on the VAT return, as Arabella's just shown you through the Xero example. The contractor will invoice the £2,000 plus the £4,000 output VAT, because they're invoicing to an end user, so they invoice their VAT as normal, and then their VAT return. So this is the key part here that's probably going to be useful for all contractors. Their output VAT, that's £600 showing there, is made up of the £400 above, which is their true output VAT, plus the £200 DRC charge. So what should be the subcontractor's output VAT, that also goes into their box 1 output VAT. And then the input VAT is the £200, the DRC charge, which normally they'd be able to reclaim as input VAT. If they were charged by the subcontractor, they're still able to reclaim that £200. So in total, HMRC are receiving £400 from the contractor, as opposed to £200 from the contractor and £200 from the contractor above. HMRC, you can see, are receiving the same amount, but it's all coming through the contractor to avoid the subcontractor fraudulently keeping that money.